ING's monthly report, gold monthly rally might not be over just yet. Just recognize that they're conservative. They're not gold bugs. The decline in gold, traditionally a safe haven, I'm quoting them, traditionally a safe haven here, was attributed to liquidations aimed at covering margin calls on other assets. Now, I've never heard a bank say that publicly in a for public consumption, which is a reason to buy it. I mean, that's like a bank saying gold's a buy, and they don't usually do that even when they want to. Despite the setback, gold remains up approximately 15% year to date, they remind us.
The price of gold has been on a largely undisturbed upward trend this year, breaking numerous price records since January. The precious metal was priced at $2,063.73 on January 1st, but has broken numerous price records since then. The latest record, set July 17th, saw the metal surge to a new record of $2,472.46 per ounce. At the same time, it's come down slightly since it's still high and could soon eclipse a new record. Based on ING's recent monthly gold report, seasoned analyst Vince Lanci is bullish on gold's longer-term position. Despite the recent decline in gold prices, the ongoing geopolitical uncertainties, and expected interest rate cuts by the U.S. Federal Reserve could provide strong support for gold in the future. Gold prices will peak in the fourth quarter as investors focus on Fed cuts, while ETF inflows and central bank buying continue to provide support against a backdrop of geopolitical risk, according to Ewa Manthey, Commodities Strategist at ING. In discussing economic drivers and monetary policy, Lanci mentions that the anticipated shift in U.S. monetary policy is central to ING's outlook. Fed rate cut move could lower borrowing costs and boost gold's attractiveness as a non-yielding asset. He suggests that while American investors may not have been driven to buy gold recently, this could change as the economic landscape evolves. According to Vince, the previous decline in gold was due to liquidations, a rare public admission from a bank, which he interpreted as a strong signal to consider buying gold. Gold joined the global sell-off of equities at the start of this week, driven by growing concerns over the U.S. recession risk. Gold, usually a safe haven during such uncertainty, sold off sharply on Monday, amid likely liquidations to cover margin calls on other assets. Now, we present the clips of Vince Lanci's insights from his recent interview. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
And moving on to the ING report. Right. The report starts, ING's monthly report, gold monthly rally might not be over just yet. Just recognize that they're conservative. They're not gold bugs, but they give pretty good recaps that confirm what we've been talking about for months on end. However, they can't take the risks that we can in publishing. So therefore, let's read what they say and let's add to it where appropriate. Well, the report, I'm not going to say the report on air. I'm going to give you my write-up on it, my recap of it. The report starts by noting the sharp sell-off in gold at the beginning of the month. This is written before yesterday's rally. Okay. It then offers a they're very cautious in their price prognostications, outlook for gold prices, driven by ongoing geopolitical uncertainties and anticipated interest rate cuts by the U.S. Federal Reserve, things that listeners to this program know about. Before they get into that, they touch on the current market dynamics, right? And that would be, they begin by addressing the notable drop in gold prices at the start of August, again, before yesterday, which coincided with a global sell-off in equities. That's the whole yen carry trade, dragging gold down with it. They believe the decline in gold, traditionally a safe haven, I'm quoting them, traditionally a safe haven here, was attributed to liquidations aimed at covering margin calls on other assets. Now, I've never heard a bank say that publicly in a for public consumption, which is a reason to buy it. I mean, that's like a bank saying gold's a buy, and they don't usually do that even when they want to. Despite the setback, gold remains up approximately 15% year to date, they remind us. Next, they move to, so there's the gold drop chart that goes with the description I just gave you. So looking ahead in the report, they reassess several key factors expected to support gold price. So those would be economics, geopolitics, and what I would call known calendar events. So event risk. And then they update on central bank buying factors. All things that readers here are very familiar with, but let's just read it. Let's just talk about it in someone else's words, right? So we're going to start with economic drivers and monetary policy. That chart's for the next section. Economic drivers and monetary policy, they don't have a chart on that one. Central among these is the anticipated shift in U.S. monetary policy, they believe. The Federal Reserve, having maintained its key interest rate at the highest level in over 2 decades, is now expected to initiate a series of rate cuts starting in September of 24. This shift, motivated by a slowing economy, would reduce borrowing costs, thereby enhancing gold's appeal as a non-yielding asset. Now, that concept is tried and true, and it's still true in the U.S. So why has gold rallied for the last year? Because the U.S. isn't buying it. See, that's the point. The opportunity cost of gold in U.S. terms, interest rates, isn't a problem for Americans. We're just like, okay, we're not going to buy gold yet. However, in China, if bonds are at all-time highs, right, and interest rate costs are lower, and the dollar is no longer part of your day-to-day risk, you're going to buy gold. And you're not going to worry about U.S. interest rate risk because you're not dealing in dollars as much anymore. Anyway, this will dovetail nicely into the ETFs. So keep this in mind in the back of your head. Say, okay, there hasn't been much demand due to interest rates dropping, but now there could be. And that's an American comment. And that's fine.
Vince Lanci's analysis suggests that central bank gold buying, particularly by China, remains robust despite official reports suggesting a slowdown. He argues that China's strategic pause in public gold purchases is likely to influence market prices and enable other BRICS nations to accumulate gold ahead of the summit. Meanwhile, according to official data, China's central bank didn't add gold to its reserves in May, ending an 18-month buying spree that had driven gold prices to record highs, with high gold prices likely to have deterred further purchases for now. Bullion held by the PBOC was unchanged at 72.8 million troy ounces at the end of last month. Regarding the shift in Western investor sentiment, Vince notes that the expectation of rate cuts has renewed interest in gold, evident in the positive inflows into global ETFs. He expects gold's appeal as a safe haven asset to grow stronger with escalating geopolitical tensions and the U.S. election. Let's get back to the interview.
Central bank buying, it's safe to say they are still buying for the foreseeable future. Now, that's not a facile term. It means they're going to keep buying until after the election. Central bank remain the key players in the gold market, with continued net buying reported, particularly from emerging markets. The report notes that recent slowdown in purchases by PBOC, official gold purchases by China, which has paused its gold acquisitions after an 18-month buying spree. This pause, likely due to the high gold prices, could temporarily dampen demand. Despite this, ING expects central bank demand to remain strong overall, providing ongoing support for gold prices. Okay, stop right there. They haven't stopped buying. They've stopped publicly buying. They're buying as much or more as they have been. I just know this. I've known it for years that China doesn't buy most of their gold through the PBOC. The PBOC holds small gold compared to what the country owns for backing its own currency. So you're going to start seeing reports about that come out because gold's going to keep going up, and someone's going to discover that China is still buying gold. And we're going to say, yeah, of course they're buying gold. They have been forever, and they won't stop until they're done. The other reason that they're publicly not buying gold as much is because they want the price to go down. They're signaling that they're going to buy more if it goes down, and they're making room for other BRICS players who need to buy before the summit, like India, who has been buying when China has not. So the PBOC not buying is like saying, I'm not buying, and George Soros is still buying. It's just ridiculous. Moving on to ETF inflows. Now, I think this is probably the most interesting thing in terms of ongoing. They observe a shift in investor sentiment. Remember, the Fed's going to ease. That means Western people will start saying opportunity cost isn't as big. I can't get 5% on my money market anymore. Therefore, I'll start throwing some money into gold, right? So they note the shift in investor sentiment as evidenced by the inflows into global gold ETFs, global. Think US, UK, Switzerland. Don't think China. They're still buying in China, as evidenced by the inflows in global, which have seen positive inflows for 2 consecutive months. That's not a trend likely to reverse. If this were any other year, I'd say, it could be noise. You have to watch for stuff like this, these little 3 thing here. But this is going into the BRICS summit, going into the election, going into the Fed easing. There will be, I believe, there will be almost guaranteed more gold buying. And you can see that because stocks drop, gold drops, stocks rally, gold rallies, right? And then sometimes you'll see stocks drop 3% and you'll see gold rally 1% afterwards. Gold is up more than stocks this year. And we haven't even started buying yet. Western interest is back. That's what I'm trying to say. So it's a reversal from the broader trend of outflows earlier in the year, which we've seen for a long time, right? And particularly from North American and European markets. ING suggests that this renewed interest in gold ETFs reflects a broader acknowledgement of gold's potential as a hedge against both geopolitical risks and financial market volatility. That's what we've been saying. Their price outlook is very conservative, however. Their price outlook says that gold prices will continue to rise, peaking in the fourth quarter of 2024. The bank forecast an average price of $23.80 an ounce in the third quarter, with a potential peak at $24.50 per ounce by year end. This outlook is underpinned by the expectation of continued central bank buying, geopolitical tensions, yada, yada, yada. The prices, they think it'll peak at $24.50. Well, we think if it goes to $24.50, it'll go to $2,500. Because there is a cap at $24.50. And if it gets above it this time, it's going to rally to $2,500. And who's going to stop it if the election is contended or if the BRICS continue to speak very well about gold?
The ongoing dynamics of central bank gold buying, particularly from major global players, indicate strategic maneuvering that could significantly influence market conditions. The structural drivers that have helped gold's rally so far will remain a critical bullish driving force, with J.P. Morgan economists expecting a Fed cut to come in November. Considering these factors, do you believe gold will continue to hold its value as a hedge against economic and political instability? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.